I want to welcome everybody here, ladies and gentlemen, on behalf of the entire team of WealthWorks. We're delighted you could join us today. And I would like to, go ahead and introduce Mr. Anupam Tiwari, who's joined us today. So Anupam has an illustrious career in the fund management space. He is quite famously known for his Access Small Cap Fund, which he manages. In addition to Access Small Cap Fund, he also manages Equity Savings Fund and the Balanced Advantage Fund. And also, he's being given the responsibility to manage the new Access Multicap Fund, which is a huge responsibility. So, Anupam, we're really looking forward, to seeing you manage that fund as well. So, let's get started into the discussion. So, welcome, Anupam. And I think the question that is on everybody's mind at the moment is, what is really happening to the, markets? Is the equity rally over? What's the way forward? So if you can just shed some light on that, and then we'll get into some more specific questions.
Thank you everyone, and good evening to everyone. Good afternoon, depending on how you look at it. Thanks for giving us time and listening to us. So, see, I think what is happening to market is basically naturally what should happen to the market. It's but natural after such a long and fantastic performance, there has to be some correction, right? And that is what is happening. So I don't think there is anything abnormal or anything that one should be heavily worried about. It's nature of the market to go up and go down. One has to embrace that volatility, and then a lot of people will ask question what to do, how to look at it. You may invest, market may fall by 5-10%, etc. Yes, that can happen. That's absolutely possible, and we have absolutely no clue. At least I don't have any clue to tell you with assured confidence that okay, market will stop here or it will fall so much in so much time, it will go up so much. It doesn't happen like that. So one has to embrace this volatility. That is very, very important. And the only answer to volatility is time. There is nothing else that you can do. If you try to time the market, trust me, you will go wrong. And at times you will go horribly wrong. So net in market, generally, anything that would not be so positive after such a long rise will have a negative impact and it will fall. That's the honest answer. Now, I can give you 5 reasons why people are worried, including Omicron and, some bit about what's happening to US interest rate or inflation, etc., etc. But that's a cycle that keeps on happening, right? It's all post facto analysis that we can do.
Right. So I think one thing that's really been bearing on everybody's mind is, the new COVID variant and what the impact, maybe it's too early, but we definitely like to know what's a fund manager's take on how this, new variant could, impact Indian markets as well as, global markets, and what will be the ripple effect.
Yeah. So, of course, we are not virologists, so we don't know how it will happen or not. We just keep on looking at data, etc., and what people are saying about it. And then we built up a solution, a scenario, right? That what are the things that are possible? So let's say what is the worst case thing possible? Is that it is much more lethal than Delta, correct? The Delta variant, which caused the second wave for us. Now, what happened during Delta is that if you look at in aggregate, and as compare it with previous cycles number, the death rate was slightly higher, but not significantly higher. But the spread and infections were much more as compared to the first wave in the second wave, right? So the sheer number was very, very high. But if you look at closely examine what was the death rate, etc., it was not very, very significantly high. So it was slightly higher. That is one part. So system over after 5-7 days, let's say latest after 2 weeks of chaos, system was able to cope up with the increased number. So that's one thing that we need now. And even if worst case, this Omicron variant is much more lethal. Now, there is also a theory in virology that something which spreads very fast is not that lethal, right? And something which is, so the if infection rate is very, very high, it is not very lethal. So right now, what we should look at it and focus on is that what could be lethality of the virus and what could be its impact on the economy, in the sense that do we need to lock it down, use lockdown as a strategy? If you remember, in second wave, there was no nationwide lockdown. There was sporadic lockdown in certain states and then in certain cities, etc., over a period of time. So even after considering a high lethality, I think now system would be much more prepared to deal with it. So I don't think, except the service sector, which is, let's say, malls, the retail, airlines, hotels, etc. Other than that, in worst case, there would be any very big impact on anything. And if it is as good as Delta, in terms of its infection rate and lethality, then I think we are good to go. We have no problem per se. We can deal with it. And we will be better positioned to deal with it as compared to the second wave. The third and most important question is that, are we going to have protection against it using the current vaccines? Now, so we had a very brief chat with one of the vaccine company, and they are saying that as of now, it looks likely that they will have, but they are also working, because it's a very, very recent event, and the complete sequencing, the complete new virus, they don't have a perfect, they don't have a proper specimen to test it, etc. And most of the vaccines that we have, let's say mRNA, creating a new vaccine for this new vector is very easy. It's not even 24 hours that they will take, right? The one vaccine that we have, Covaxin, it is very easy to replicate with the new vector, which is basically using the new virus. Because what they are saying is that the new virus has huge amount of 32 total mutations on the spike protein. So basically, on that genetic side, there are 32 new changes that have happened in this mutation. On the Covishield side, we are not yet sure, because they use adenovirus. So how they will implement it, but of course, what they have said that they have a proper methodology to upgrade the vaccine. So with booster dose, etc., maybe in 2 or 3 months of time, we will be able to handle it. So net as of now, if you look at all the scenarios, maybe worst case 1 quarter of impact. That is worst case. And I don't think that we are going to see a absolute lockdown of the system. I think it could be selective, because even after second wave's problem, there was no nationwide lockdown and quite a things were open. So let's see. And even if you take that worst case, 1 quarter, because by that time we will have upgraded vaccine and booster doses can be administered. See, now the capacity of vaccine system is very high, right? We are making more than 25 crore doses a month. So even if a booster has to be made and delivered, it could be pretty fast.
Thanks, Anupam, for those inputs. One more concern that's been going around off late is the concern of inflation.
Yes.
Right. So how real of a concern is that? And what would the impact of inflation be on the markets?
So see, whenever inflation happens, you try to analyze whether it is happening because of higher demand and supply not keeping pace with it, or it is happening because demand being on a trend line, the same trend line, not going up big time, but supply is not there at all, and that is causing inflation. Now, the first case is a bigger problem, because then you have to worry that how you control demand, how you need to bring demand at a sustainable level so that the supply can keep pace with it. The second problem is something that you cannot do anything except that you solve the problem of why supply is going away. So this whole inflation that is coming in is basically because of the supply has been very, very problematic in last 1 year or so. And there are multiple reasons that have happened. So except semiconductors, where the problem is structural demand going up because of most of things moving online, digital, and the supply not keeping pace with it. Because it takes a lot of time to put up a semiconductor plant. And now everywhere people demand semiconductor, and there is huge demand of tablets, laptops, cars are demanding new kind of chips, etc. EVs are coming up. So there is a problem, but there is no supply, right? So it's not question of inflation and you paying a high price and still getting the supplies. Factories will come up online. It will take 1 or 2 to 3 quarters more, and slowly that would be solved. But all other things are a function of problems in supply chain, because there is nothing else in the world where demand has gone up substantially. Except few things. In fact, we are still kind of touching the pre-COVID level of demand. But the supply has been problematic. And this is mainly because of the fact that most of the world's raw material and a lot of finished, semi-finished goods are being supplied out of China. So first there was this shipping problem. So first there was the whole issue of COVID in China. So they locked it down and then they opened it up. Then happened this shipping problem because one ship got stuck. Then there was a driver's crisis in US. So that container problem started. Then Chinese port was once again closed down because of COVID and all that. So this is causing all the problems. And so this inflation is not structural per se. Yes, US inflation is a different thing, because US, the labor participation is going down because everybody is enjoying. They have got so much money from the government that they don't want to come back to work. So that's a big problem, and it will take its own sweet time to correct. And you cannot do anything about it except that you stop giving money to people, right? And at some point of time, US government will take that call that they will stop and they will reduce the subsidies, etc. But in India, I think we are okay. As soon as this supply chain problems are sorted out, and I think they have started. So we are seeing container rates going down. They have come down from top at least 30%, 35%. And in that festive season, there was also big demand for container ships. And this is generally post-Christmas. Generally, there is a slack season, because up to Christmas, the demand for consumer good, gift items, everything goes up. So that's, I think, post-Christmas.
Would you say you did spend some time on the supply chain shortages, and would you say it's already factored in the earnings, or how do you see the impact on the earnings and the earnings estimates for how many quarters going forward?
No, of course, earnings are getting impacted, because if you see, most of the companies are seeing margin compression, right? Because they have not been able to pass on, because in between prices have gone up significantly, and they were going in so fast and very closely that it was very difficult to pass it on to most of them. So be it consumer companies, be it business to business supplier, everybody has seen margin compression. So I think that will continue even in this quarter. And maybe from Q4 onwards, there could be some respite on that.
Okay. And so you spoke about structural inflation being temporary in inflation being temporary in India. In the US, it's a different story. So can you just shed some light on the US inflation, US interest rates? I'll kind of tag in one more question from a customer who's asked what can we, is the US debt ceiling going to affect our Indian markets and global markets? Right. So if you can just shed some light on that.
Yeah. The problem with US debt ceiling is that there is no debt ceiling, right? Every time they come close to that debt ceiling and then they just raise the ceiling. So, I don't think in US there is going back to similar kind of very conservative fiscal policies. It's difficult because for last 10 years or so they have accepted right? And they need to continue to maintain growth because otherwise this kind of debt cannot be serviced. So US has amassed huge amount of debt, everybody, consumer, be it government, etc. So you need growth. Otherwise you will have to borrow to pay interest, right? And that you cannot do. Nobody can sustain in that level. And to have good growth, you need to have low interest rates. And one thing you need to understand is that US is committed to not to become Japan or Europe. So, the kind of mistake that Japan did, the kind of mistake that Europe did, US guys are intelligent enough to understand that we cannot go into a very slow growth scenario. Japan still survived that slow growth scenario because most of the borrowings were local. So they were happy that, okay, our growth is not there, but there is also zero inflation because there is no demand growth and there is no inflation. So we are happy. Everything is in equilibrium. Unfortunately, that is not the scenario in US, right? Because debt is growing. So you need to have growth to sustain that. And hence, I think they would be very, very calibrated, very careful in terms of hiking the rates. Of course, rates have bottomed out and they will go up. That is for sure. That is not a question that one has to try to answer. The question is how fast. So I think depending on situation, how the situation pans out, they will start to, in a calibrated manner, they will start to hike. And if they are calibrated, if they are mature enough to understand and not to shock the system, then it would be fine. I think slowly and slowly system will adjust. See, one thing is now sure that everybody in US realizes that rates are now going to go up because everybody is talking about that. It's just how you season the system, right? How you condition the system. So it's not going to be a shock at all.
Fair enough. So Anupam, let me ask you a very broad question before we go into some specifics. So for almost all our clients, mutual funds and equity mutual funds form a significant portion of their investment portfolio. Of course, they do have other products, but a significant portion is in equity mutual funds. So if you take the last 20 years, equity mutual funds have given, there's a really good track record, right? Looking back. And there's a school of thought that probably you may not get the same kind of returns over the next 10 years or 20 years. What's your take on that? Are the best days behind us, or what's your take?
My personal opinion, I think in next 20 years, we are going to do better than last 20 years. Okay. And I will explain you my theory about it. It's my theory, not so polished, not so data-driven like a research scholar or an economist can do. It's a pure fund manager perspective to look at things. See, pre-1991, this country was a big chaos, right? We really started on our opportunity, on our potential in 1991, correct? Initial 10 years, nothing happened. If you look at from it, all the growth, all the good things started with IT boom. And the first sector per se to start doing well, becoming global, really benefiting out of that whole liberalization, etc., was IT. And it's a very pertinent question to ask why a service sector boomed and not a manufacturing sector. Though India was supposed to be a low-cost country, etc., there was a reason for that. And during the same time, approximately same time, we had this big divergence of view that the optimist in India said that now next 20, 30 years, India is going to do great. And the pessimist every 4 or 5 years came and said India is going to collapse. None of these things happened. We are one of the unique country in the world which in last 20 years disappointed both optimist as well as the pessimist, right? Now let's start again from 1991. So why there was no manufacturing renaissance or big growth in manufacturing as compared to what happened in services like IT, etc.? Because in 1991, we left the socialistic model of economic management and embraced capitalism. But the system was not ready to embrace it. So at decision level, we said, yes, now we are going to manage our economic system as a capitalistic system, and the political system still remained socialistic. But unfortunately, how to manage these two contradictions in political and in economic management was not known to anybody. So they took their own sweet time, and that is why service sector, which has least interaction with the government and requires least intervention from the government, did very, very well, correct, initially. And then people realized that India will not grow just by changing some policies. You have to do some groundwork, right? So during 2000, 2001, then government started working on infrastructure projects because our infra capacity was a mess. So we started highway program, we started privatizing electricity sector, we started privatizing so many things, companies, etc. Once again, the contradiction between a socialistic political arrangement and a capitalistic economic arrangement came, and then we have all these problems for last 10, 15 years, right? But what has happened, if you look at last 20 years, we have developed extreme amount of capability at both levels. So we were always very good at individual capability level. And that is why pessimists always failed in India when they predicted collapse of the system. Because whenever they felt that system is not good enough to take care of any crisis, the individual capability which was so high used to come to the rescue of the systems, and some institution used to be so good that they always prevented collapse of this country. Correct? And hence this country never collapsed. At the same time, the optimist never appreciated the unpreparedness or incompetence of the system, which can channelize the individual capability or some institution's capability and make it a very good growth path. So that was the problem. But in last 20 years, we have sorted out so many things in this. So we have developed a lot of infrastructure. Our infra is good. Government and the bureaucracy is now more appreciative of the work of private sector. So it is embracing them. There was a big time when there was disbelief on the private sector from the bureaucracy and from the government. People used to think that these guys only want to make money. There is no other benefit that society will drive from them. But now they have realized after last 5-7 years of working, etc., that yes, we need to embrace private sector to do good things in India. And hence this whole big privatization drive that is going on. Government has also developed the institutional capability to handle big capacity, large projects. We are doing the largest ever project in India, that is Mumbai-Delhi expressway. It's more than 1.25 lakh crore project. It would be completed in 4.5 years. Look at this speed, right? 1.25 lakh crore. So system has also developed capability, regulatory capability is there, government understanding is there, and in last 20 years we have created world-class companies. In last 20 years we have created huge amount of talent. We have trained them. They have understood, they have interacted with best of the world in terms of competition, in terms of collaboration. And now that there is a clear understanding that how to do things, what to do. And on top of that, 20 years ago, India lacked risk capital. Correct? And hence growth was constrained. Now we don't have any dearth of risk capital. Every big private equity fund is available in India. Indian stock market is very benevolent to smaller companies or any companies. In last 5 years, I don't think any good proposition has got rejected for need of capital. Anybody who has a good business plan, anybody who is backed by good team is getting capital. Right? So the combination of all this, and there is always a demand, right? In India, there are 150 crore people, so there is no dearth of demand. So this gives me very high level of confidence that next 20 years are going to be better than last 20 years. And if you just rewind last 10 years and you start from 2011-12, right, and look at what happened in the 10 years. So 11-12 policy paralysis, problem of governance, 13 taper tantrum, 14 election happened, then demon disruption, then GST disruption, then NBFC crisis, then 18-19 slowdown, and then COVID happened. Even after all this, and these were serious problems, Indian economy continued to grow at a modest pace. It was not as good as people would have expected it to be, but there was a modest growth. This tells you the inherent strength of the system. This tells you the inherent strength of the Indian economy. So next 10, 20 years, we are not going to see these severe problems. There would be problems for sure. No country will ever have a next 20-year run without any problem. But last 10 years tell you that we are now much better prepared. We are in a much better shape to deal with these problems. And there is immense amount of capability that is developing in the system. So that gives me extremely high level of confidence. The next 20 years are going to be far superior to what we have done in last 20 years.
Quite an interesting theory there, Anupam. So, I mean, not the kind of answer that we would have expected or some of our clients would have expected. We have some industry leaders as well on the call now. So, I mean, thanks for sharing that theory. We'll look forward to hopefully the theory coming true. Let's get into some specific questions. You mentioned that there's no, dearth of risk capital. And as you know, we've been watching a sea of NFOs, of course, IPOs, and, on the mutual fund space, a lot of NFOs. Almost every mutual fund company out there has brought in at least one or two NFOs, right? Full disclosure here, as a distributor, as a wealth management company, if we promote an NFO, right, we make a little bit more than a usual fund, probably about 15-20% more of trail commission. So it's a big advantage for us. But is there any advantage for a client to look at an NFO? What's your take on this? And after you share, I'll get into some specifics on your access funds as well.
Okay, so the first question that we need to answer is that why AMCs have very different multiple products, right? So now one thing is good that SEBI has brought in some kind of uniformity in the way we define the products. Correct? Earlier, I have my own definition, HDFC has their own definition, Pru has their own definition, etc., etc. So now there is a homogeneity and similarity of definition. It's same definition that everybody has put out. So that's very good. Now, why you need different products? So see, every investor is not same, right? Second is that every investor has a very different level of understanding of investing and market. So for example, let's look at what is difference between a large and a small cap, and what is difference between, let's say, multi-cap and a large cap fund. So a lot of people, it becomes very, very difficult for them to appreciate this difference. Ideally, if an investor is highly educated and is absolutely aware of everything, then you just need three products: large cap, mid cap, small cap. That's it. Because any other combination can be designed using these three products and mixing them with debt products, right? Theoretically. It is theoretically right, but it is very difficult to do it practically in real life because sentiment, emotions, timing, etc., create a lot of problem for investors as well as advisors. So that is why we create multiple products which are customized for certain things. So we create hybrid products, we create separate small cap, we create separate large cap, we create separate large and mid cap, we create separate foreign products. Now we have come out with multi-cap, we have a flexi cap. So the whole idea behind this is to solve the problem of investor and also to give him a convenient option to invest and have peace of mind. So that's the whole idea why we've launched so many products.
So now let's follow up to that question. So Axis did launch a lot of funds between 2010 and 2013, right? Your Axis Blue Chip, Axis Mid Cap, Axis Focus, right? And of course, the performance has been stellar over the last several years. Why should somebody invest now in your new fund, Axis Multicap?
I think the most important factor would be our track record. Is because we have demonstrated that in last 3 to 5 years we have done well in all the categories, right? In the large cap, in the mid cap, and the small cap. So I think that is the biggest reason for anybody to look at us, consider us, evaluate us for investing in this multi-cap fund. And I don't think there is any other AMC which has such a consistent track record across categories. So somebody will be good, better than us, maybe in large cap, somebody would be in mid cap, somebody would be in small cap. But we are one of the very few, I would say maybe one or two guys who have a consistent good track record across categories. So that is one. And this fund is a combination of three categories: large cap, mid cap, and small cap. So that gives us a real reason for seeking your money.
So
the second thing is
access philosophy. Go ahead.
The second thing is access philosophy. That we focus on quality and growth. So this is something that has worked very well over last 10 years. We are very committed to it. We follow it religiously. And hence, this commitment and this thought process should give confidence to the investor that even in next 5-10 years, we can create wealth for them.
Fair enough. One question on, considering that you're launching a multi-cap fund, why should somebody go for a multi-cap fund when there's already a flexi cap category, right? So flexi cap category does not have any restrictions. You can move between the large cap, mid cap, and small cap as the fund manager, sees fit. So when we have a flexi cap fund, why should we, add in a multi-cap fund as well? What's your take on this?
Yeah, that's a good question. See, you will always have higher exposure to small and mid cap in a multi-cap fund as compared to flexi caps. So you are right, theoretically it is correct. Flexi cap in fund manager can create any portfolio, etc. But predominantly they are large cap products with some exposure to mid caps and then tactical allocation to small caps in an opportune time. But nobody expects them to have 30% small caps, right? I don't think even advisor will like it when flexi cap fund managers start making their portfolios and exposing them to 25-30% as a small caps. Because it is basically large cap plus kind of product. That you do large caps predominantly, but have some exposure to mid caps and some very little exposure to small caps. So in this product, you will always have very high exposure to small and mid cap. That's the very, very important and key difference with a flexi and a multi-cap.
Fair enough. So what you say is there's a mandate and, fund managers will follow the mandate, whereas in a flexi cap, even though the flexibility is there, practically it may not actually happen.
Yes.
Sure. Thanks, Anupam, for those thoughts. So we'll go ahead and get started with the questions that our clients have. So we have a bunch of questions that have come in through our WhatsApp and Google Forms. And as well as, would request all the clients, please feel free to share your questions or chat. Or if you'd like us to unmute you and, you can ask your question directly to Anupam as well. So, Vaikunth sir, I think you would like to get started with the first question. Yes, we'll unmute you in a minute, sir. We're just, in the process of unmuting. Yes, sir, go ahead, sir, please.
Thank you, Anupam, for your very good explanation of 20 years back and 20 years forward. That was quite encouraging for the investors. My question, I have two questions. I'll ask both of them. Has investment source like HNIs, FIIs, SIPs in the last few years have changed the investment scenario in India, and going forward, how it is going to affect the market? That was one question. And the second question is, when we are talking about small cap and mid cap, with the levels what it was just before the Friday meltdown, should we be continuing in small cap and a small portion in mid cap and concentrate on large cap? How do we go about it? Thanks.
Great. Thank you. Thanks for your questions. So on your first question, how the flows are going to impact and change? Yes, they will continue to chase the best return, right? The intelligent money, the HNIs, the FIs, the institutions, they will continue to see the opportunities where best return can be made. So there are a couple of things here that one has to consider. One is that the thought process of Indian investor is changing for sure. So you have much more awareness about financial product and you have much more inclination to invest in them. It took 20 years for our industry to explain, go create that distribution, explain to the investor that what he can attain with mutual funds, etc. And that is driving that acceptance of a financial product. And this will continue. The new generation that is coming in today, let's say somebody who is now 20 to 23-year-old and who is making his first income, he has seen this ad of mutual fund sahiye for last 10 years. So for him, mutual fund is not something alien that needs to be explained to him. It will come natural to him. So that is why flows will keep on increasing in the equity side as well as debt side also. But I have a different perspective on flows, right? Flows drive market in short term, not in long term. Because long term fundamentals drive the market. So if one has to focus on making money, you need to focus more on fundamentals than the flows. Because today flows are there. If fundamentals are weak, flows will go back. Everybody will become a seller. Today, most of the people are buyer, but be it HNIs, be it FIs, everybody will become seller if companies don't deliver. If India doesn't deliver, nobody will invest in equities. So as long as our fundamentals are good, people will keep on investing money in equities wherever they could find opportunity. So that's on the flow side. On the second question of your whether you should continue with a small and mid cap, yes, you should continue with a small and mid cap depending on your plan. However, the only two questions that you need to answer before investing in a small and mid cap. Point number one, are you able to have that kind of time horizon or not? For example, in our small cap fund, now I suggest people to have a 7-8 year time horizon. Because we cannot make money in next 1 or 2 years. Even if we make it, it would be by chance, not by some proper understanding or by growth. So you need to have 7-8 year time horizon for at least my small cap fund. The second thing is on the volatility part. Small caps and mid caps are very, very volatile thing. So if you can go through that volatility, if you are happy with your portfolio, some part of your portfolio going down by 20%, 25%, and it doesn't make you, shiver and it doesn't impact your investment decision making, yes, you should invest in a small and mid cap. Because if you look at last 5-10 years, small cap and mid caps have been the best performing categories. And I strongly believe in next 8 to 10 years, they will once again remain best performing categories. But that ride is not smooth. So if you can go through that pain, then yes, it's a fantastic category to be.
Thanks, Anupam. So we have a couple of questions that are similar. I will try to bunch them and ask you. So we have one question on the chat box by Mr. Srinivasan. So lofty valuations of new age companies like Zomato, Nykaa, Paytm, etc., which have no relation to their earnings, even if you look 10 years down the line, and promoters are selling at these valuations, that the markets are overheated, right? So the question is, how do we justify these kind of valuations in these new age companies? We also have, and is the market overheated? We have two more questions that have come in. Which basically says, is the market overvalued right now? As I'm a long-term investor, should I wait for a correction to happen before I enter? And another question, same thing again, are the markets overheated?
So on the new age companies, I think, in every bull market, this happens, right? The theme of that bull market always gets overvalued. So it happened in 2000, 2001, 2, when the technology, the IT companies, the software companies were overvalued. In 5, 6, 7, it was infrastructure company, etc. they were overvalued, and then now this is happening. So this is very common for a bull market. But what we have to see is we analyze companies and see who is more likely to deliver. And if companies deliver, we can make money from here also. In certain companies, not in all. And generally, you will not make money in all. You will make money in only few. So we have to examine, we have to see what happens. And on losses in terms of earning, etc., see, these companies don't have capitalization concept, right? For example, a cement company, when it puts up a cement plant, it capitalizes everything. So all 4 years of salary putting up that cement plant would be capitalized. These companies write off everything. So they will have losses. But if they can grow, if they can have that pricing power, if customer is willing to pay to them in next 5-10 years, then yes, in some companies, not all, money can be made. Right? Because once that profit growth happens, it happens pretty fast. So one has to examine, carefully observe them, and then make an investment decision. So that's on the tech part. And second part is on valuation. So yes, in some, I would say like this, the money to be made in anything is over. That time is over that you can buy anything and make money. I think that opportunity is gone now. You have to be very selective. You have to really find a good idea and see whether it can deliver or not. And then only you will be able to make money. So that's on the valuation side.
Sure. There's a follow-up. I mean, there's another question that has come in very similar to what you answered. You probably answered part of it already, where, for these new age companies, the business cycle is quite short. So he said, you have to make money. The cycle that you can make money is quite short. So is, investments in long-term investments in technology funds, sector oriented, is that justified?
See, generally, I don't recommend any sectoral funds. It's not just technology, any sectoral fund, because market is never homogeneous in terms of its prospect for any sector. Sector keeps on going up and down depending on time. So one should remain diversified. In my opinion, I will never invest in a sectoral fund per se.
Sure. Okay. Thanks for that, Anupam. We have another, question that's come in, via chat from Mr. Vasudev. So there is a view that alpha in mutual funds are on a decline and will eventually disappear, like how it has disappeared in the US. So do you share this view as well? And if you do not, then what's the kind of alpha range that you expect in the funds that you manage?
See, alpha is not disappeared in US. It has shifted to different product because the normal products have become index funds. So there are two things you need to differentiate. So there are ETFs which are customized portfolios. And in US, selecting ETF, finding ETF is expensive. It's not cheap. Right? The index funds are cheap. So, and of course, index funds are really big in US because people use them and they are very stable. In India, because we are growing, so at least in mid and small side, we strongly believe that we can create alpha. Strongly, we can create alpha. And this will not happen every year. This will happen in a block of 5 years. Maybe 1 or 2 years, we will have bad years. In large cap side, yes, it is slightly difficult, but it is still there. Because see, India is evolving. You cannot say that, okay, only these are the companies which are going to grow. New things are coming up. And in next 20 years, 10, 20 years, furthermore, new things will come up. Certain things will grow, certain things will not grow. So I think still there is good opportunity to make alpha in India.
Fair enough. Thanks, Anupam. We have another, question from a client who's asking, what is your view on balanced fund category? And you also do manage the Access Balanced Advantage. Yeah. So what is your view on balanced funds?
See, it's a very good category, but you need to have need for it, right? If you have a portion of money or portion of funds that you don't want to lose at all, and you can give it 3 to 5 year time frame and make slightly higher than debt returns, then certainly this category is good for you. Because on a 3-year rolling basis, our analysis suggests that in our product, you cannot lose money. So it's a low risk, low volatility, good return product. It's not best return product. that you have to understand that it is not for the people who are seeking best possible return. It's not. It's a reasonably okay return, but it gives you extremely low volatility. So certain money that you want to use for next 3, 5, 7 years, but you don't want to lose it at any given point of time, then this is a good product for you.
Noted, noted. So we have another, question. Is it good to accumulate fundamentally good stocks during these corrections, or even those that are overvalued? For example, Tata Steel, JSW are still going down in spite of stellar first 2 quarters. This is a question on the chat by Mr. R. Krithivasan.
I am sorry, I won't be able to give you any stock specific idea or recommendation or analysis.
Okay, fair enough. Okay, so as a basket is what you recommend, right?
I recommend mutual funds.
Okay, fair enough. I'll club 2 questions. One question on the chat by Mr. Vinod. Is it advisable to book profits or exit completely in equity and then re-enter when the market's correct? I'll club it with another question which has come in, which is basically saying, what's your 1-year view on the Nifty? And there's a separate question, entirely separate question after you answer that. What is your 60-month view on the Nifty?
Okay, 60 months is 5 year. Okay, great. Yeah. So our first question, is it advisable to book profit and then re-enter? Yes, if you can do it perfectly, then it is perfectly right. There is no question about it. If you know when to sell, when to buy, please also let me know. I can pay you some fee, right? And if you can do it on a consistent, logical basis for the next 10, 20 years, I will leave the job work for you. So it looks good, but it's very, very difficult to do it practically, and nobody can tell you when market is at top, when market is at bottom, or when market has done enough and when market is going to go down. So that's the biggest problem in this story. Right? Now, the second question was, what's the view on next 1 year? No view. I have no clue. I know only thing that last 1 year market has done phenomenally well. So on a CAGR basis, it is not sustainable, and hence there would be correction. So that's what I know. How much, how long, I have no clue. Right? And the third thing on the 60-month, see, I think 60-month perspective, I'm reasonably positive. 5-year perspective, we can make decent returns. I don't think there should be any problem. Just give me 1 second.
Sure.
Hello. अरे हाँ सर मैं मीटिंग में बैठा हुआ हूँ, आपको लगाता हूँ. हाँ सर मैं ज्वाइन कर रहा हूँ बस. Yeah. Yes sir, sorry for this.
Sure. So you are answering on the 60-month question.
Yeah, so I think I'm reasonably positive. 60 months we can make decent amount of money. Of course, for 60 months, for this multi-cap product, you need to have 60 plus months time horizon. So it could be 65, it could be 70, but 60 plus is the most appropriate time.
Sure. There's another question that's come in, which is basically asking global equities or versus Indian equities. What is your take?
I think it is always good to have some exposure to global equities. Because a lot of things are happening globally which are not happening in India in terms of different kind of technological evolution, etc. So to participate in that, some amount of global exposure is good.
Sure. We have another question by Mr. Robert that's coming on the chat. Gold stocks or gold ETF when the market goes down, is that a good option or not?
I have no clue. I have no understanding of gold, so I cannot give you any view on gold. It's what we have read in literature, financial literature, etc., is that eventually gold will give you return equal to inflation. So when you want to beat inflation, you want a good hedge. You don't want any downside, you may invest in gold. That's all I have in terms of my knowledge about gold.
Got it. We have another question by Mr. Amrendran that's coming on the chat. Which sectors do you expect to increase growth and earnings? Would you like to comment on any sectors that look better than other sectors?
We generally are focused on consumption, be it discretionary or non-discretionary, and those B2B companies which have good client dependence or some pricing power. Let's say, for example, IT, etc. So generally, except very cyclical sectors like commodities, which are highly cyclical, which have very heavy level of cyclicality into it, we are pretty open to all the sectors that we can have.
Got it. We have probably just one or two questions left, and if anybody would like to, either use the chat space.
I can have only one or two questions because I have another meeting at 4, so I need
Fair
to have a hard stop.
Okay, so fair enough. I think we're almost. I think there's just one more question which is coming, which is more pertaining to an F&O position. I don't know whether you'll be able to answer this. So if I'm down 15-20% on F&O, should I exit right away or should I hold on? Would you care to comment on this?
Sorry, sir, I cannot comment on this because I don't know why you created this position. And I can only pray to God that your losses are recovered. But other than that, I cannot help you.
Sure. Fair enough. So we do all, we always pray our clients end up making money. So I think if there are no other, questions, we can wind up, Anupam. So thank you so much for, really being candid on this Candid Talk with us. You shed some light. And I would really like to thank Anupam, who's been with us on very short notice. So, we really appreciate that. And would like to thank your entire team from Axis, Sridhar, Mahesh, and really want to thank all our clients who made it, during this time. I know it's a difficult time for some of you, so thanks so much for making it this afternoon. So thank you one and all, and thank you, Anupam.
Thank you very much. Have a nice day. Bye. Thank you.
Thank you.